Hey, it's Mike. I am not an investing guru. I'm an average guy sharing my investment journey on the internet. In today's video, we're going to discuss the 4-month review of investing in TSLY using margin. One of the main pillars of this strategy is to invest in a covered call fund that is distributing a really high percentage. The fund that I'm investing in is in TSLY. The 30-day SEC yield is about 4.65% or about 50% a year. So one of the pillars of my strategy is if this fund is paying out 50% a year, if I can borrow money at 8% a year, that means I'm getting 42% a year of free income. The main idea is that my main position here, my TSLY position, which is worth $206,000, that main position is the backbone and allows me to borrow against it to make this other stream of income. Currently right now, this is my margin status. I have a low risk. We're going to look at the details. So I have about $122,000 before I get a margin call. I have been margin called in the past. I was selling covered calls on TSLY itself, and that's when TSLY maintenance requirement was over 100%, and I was borrowing it at 100%. So I got caught. I made a lot of money doing it, but then I got left with a massive tax bill, which I will lead to later on in the video. But the interest rate yield is about 8%, and I am paying about $1.77 in interest. So let's look at my TSLY position here. Last video, I had about like 650 shares. I'm up to 964 shares. I did add a little bit of my own money into here. Total market value about $12,989.95 with an average cost per share about $16.14. And you can see here total return about minus $2,500. The nice thing about investing in this covered called ETF is that the maintenance requirement is about 25%. And for the next payment for TSLY, it's going to be $537.36. So one of the things that I want to discuss is just overall my October number. So we're going to go through this entire column here, and then I'm going to give you some thoughts. So October 2023, when I made this video, this is the account value, so $13,009.24. The margin amount is about $9,867.69, which puts us using margin at around 76%. So like I mentioned earlier, I was adding a little bit of my own money into this account. So you can see that we've gotten a little bit more equity without using margin. And the total gross payout was $537.36, which puts it at about a 4% payout for the year, or excuse me, for the month. That's a pretty good amount of money, but I think what a lot of people who own these covered call funds fail to realize is there are two things that I think that are not being accounted for. One is taxes. I think a lot of people, they get very excited about this number here, but they don't account for the taxes. The way these covered calls are taxed is it's premium. It is option income, which gets taxed at short-term capital gains tax, not long-term. So, long-term capital gains is 0 to 20%, and those are usually for qualified dividends. This is not qualified dividends. You could own JEPI, you could own SPYI. Most of these funds make money off of income, and therefore you need to account for that. And that's where I got burned. I made tens of thousands of dollars selling covered calls on TSLY, but then I kept reinvesting it back into TSLY. And then ultimately I got left with this huge tax bill that I had to figure out how to pay, which eventually we got it paid. So we're all good. But just to keep in mind, like now I'm not going to make that mistake going forward. So, $537.36 is the total amount paid. Expenses. So these expenses are accounting for the Robinhood Gold, which is $5 a month. And the other expense would be just a margin interest rate. So, I have calculated for what it's going to be charged on the 21st. So if it's $1.70 a day, I calculated for what I would have to pay in October. So I calculated this number correctly. So therefore, I'm sure it's going to be close to this number. Once I make the next video, if you see that updated, it's probably because I was slightly off. Therefore, it's going to be okay. So now to get my tax numbers, I am in the 24% federal tax bracket. Income tax in my state is about 5%, so about 30%. So what I did is I took this number minus this number times by this number, and then my tax bill for this amount of money is $141.92. And the thing is, these are realized gains, so we will have to pay taxes on it moving forward. One of the other things that a lot of people don't account for when investing in these covered call funds or these income investings, quote unquote, is that they don't account for the amount they need to reinvest. So I did some mathematics, made some calculations, and what I found was that if you invest in a covered call fund with a dividend, a premium yield about 10%, and the share price decreasing about 10%, you still can get capital appreciation as long as you reinvest back in 25%. So what I want to do is, my end goal is like, I want my capital to be preserved as well as grow, but then also create a very impressive stream of income. So I'm accounting for reinvesting back the money we get paid out. So at the end, the net gain that I'm left after, making sure that my capital is going to be preserved as well as grow, we're accounting for taxes, is $196.81. So that puts us at a monthly yield about 1.5%. Comparatively 4%, super nice. It's high, but then this 1.5%, you're like, oh man, that's not too good. But that's after all the expenses, and this is money I can pay my phone bill with that. I could pay for maybe a tank of gas or maybe 2 tanks of gas, and that is already what I'm doing right now. And then one of my last calculations that you guys didn't see in the last video was this portfolio boost. So because my account value is about $200,000, what I did is I just did this number, divided my account value, which is $200,000, and that gave me a 0.09% boost for the month. So, ideally, after about 12 months, I would like this to add up to 1%. It'd be cool if it was 1.5%, 2%. And, if I'm squeezing out an extra percent of return per year over the long term, that is actually a really good return. So, that if the S&P 500 is returning 10% and I'm returning 11% every year, I'm beating the market. So just something to think about. And then finally, these are the actual metrics that we're at. So, the current value is about that. This is the price that I paid. So my total price paid, and this is accounting for margin as well as whatever money I got here, I reinvested back into here. So even with it reinvested, we're still down about $2,500. But, we've only been owning this for 4 months. So when I ran my calculations for the long term, you really start seeing the fruits of your labor at about the 10-year mark. So, 4 months in, too early to make any radical decisions or put the stamp down saying that this is the money maker here. But I wouldn't put all your money into this. It is dangerous to do that. I am doing that with Tesla, but I have done the fundamental analysis for it, and I truly ultimately believe that's going to turn value in the future. And then if Tesla returns value in the future, then I can keep growing this side of income, on the side. All right, but those are just my thoughts. I hope you enjoyed the video, and I hope you all have a good one.